Welcome to another podcast of the Riffle series. The Riffle, a podcast series brought to you by 10 Leaves. Our mission today is, well, it's an ambitious one. We're doing a deep dive into the absolute bedrock of regulatory integrity. And we're looking at two, hugely diverse sectors.
That's putting it mildly.
Right. We are going from tracing a single, say, 3,500 dirham wire transfer for anti-money laundering, all the way to verifying the cryptographic signature on a slot machine's software to make sure it's fair.
It's a fascinating contrast. The sources we've looked at really provide a roadmap to compliance that's built on just intense specific detail.
We're not talking about abstract legal ideas here.
Not at all. We are analyzing the specific thresholds, the time limits, the technical standards. Things like the requirement for a gaming machine's internal memory to retain data for 5 years, even if you cut the power.
5 years.
A core theme is how regulatory bodies are managing risk by demanding total transparency, both in, who is moving the money and how that money is being generated in these licensed environments.
Okay, let's unpack this. Let's start with the foundation. The regulatory architecture for anti-money laundering, financing of terrorism, and proliferation financing. AML, CFTPF. It's a huge mandate. So who's actually carrying the burden of compliance here? Who are the main players?
Well, it basically falls on everyone who touches money professionally, but they're broken down into three main groups. You've got your financial institutions, FIs, of course.
At banks.
The banks, yes. Then you have DNFBPs, which is a bit of a mouthful.
What are those?
Designated non-financial businesses and professions. So think real estate brokers, dealers in precious metals, lawyers.
So places where money can be layered, basically.
Exactly. Regulators know crime doesn't just happen in banks.
Right.
And then the third group is virtual asset service providers, VASPS.
So if you're a real estate agent, you're suddenly part of the front line against financial crime. But how do they make sure this isn't just, a box-ticking exercise? What's the core philosophy here?
The core philosophy is what's called the risk-based approach. It's this requirement that all these groups, FIs, DNFBPs, VASPS, they have to identify, assess, and then manage their crime risks in a way that's proportionate to their business.
And it's not just based on their own gut feeling, right?
No, not at all. Their entire risk profile has to be informed by the National Risk Assessment, the NRA. And that NRA has to be updated at least every 3 years.
Every 3 years seems pretty frequent for a national policy document.
It shows you how quickly the risks are evolving with new technology, new criminal patterns. So an organization can't just set its compliance program and then forget about it for a decade.
So what are the key variables they have to look at?
Article 5 lays it out pretty clearly. They have to scrutinize customer risk, the geographic areas they're dealing with, and crucially, the specific products, services, and delivery channels they use.
So a big international bank has a much higher burden than, say, a local money exchange.
A much, much higher burden. And that whole process determines the level of customer due diligence they have to apply, which we can kind of split into two types: enhanced and simplified.
Okay, so when does a standard check turn into, a serious interrogation under enhanced due diligence?
EDD is mandatory for any client or transaction that's flagged as higher risk. And this means a really deep verification. For example, you have to take reasonable measures to find the source of both the client's funds and their overall wealth.
That's a huge distinction. You're not just asking where this one payment came from.
No, you're looking at their entire financial picture. It's so serious that you need senior management approval just to start or even continue a business relationship with a high-risk client.
So the responsibility goes right to the top.
Absolutely. Then the flip side is simplified due diligence, SDD. But that's only allowed if the risk is genuinely low, and this is critical. There is zero suspicion of a crime.
And what does that look like in practice? What does simplified actually mean for a business?
It means they can be more efficient. So instead of constant monitoring, they can update client data at longer intervals or maybe reduce the rate of ongoing transaction monitoring. It lets them focus their heavy-duty compliance resources where the real threats are.
It's that risk-based approach in action.
Precisely.
Okay, speaking of scrutiny, let's get into the hard numbers, the triggers that force these systems to react.
Right. For financial institutions dealing with, say, physical cash, customer due diligence is mandatory for any occasional transaction of 55,000 dirhams or more.
AED 55,000. That's the high-value trigger.
It is. But the net is cast much, much wider for electronic money.
Here's where it gets really interesting, because that number just plummets.
It does. FIs have to perform CDD for occasional wire transfers, equal to or exceeding just 3,500 dirhams.
And that same number, AED 3,500, that's also the trigger for virtual asset service providers, right?
Yes, for any occasional transaction. That extremely low threshold shows you what regulators are worried about.
They're trying to stop structuring.
It's exactly. Or smurfing. Breaking down large sums into tiny transactions to fly under the radar. By setting that wire transfer threshold so low, they make almost every electronic movement traceable.
And once that AED 3,500 wire is triggered, the level of transparency required is just intense.
Oh, it's total transparency. We're talking mandatory inclusion of the full name and account number of both the originator and the beneficiary,
Right.
plus the originator's address, ID number, date of birth, something traceable.
It seems like every part of the chain has a responsibility. What about the banks in the middle?
The intermediary FIs, yep, they have to retain all of that originator and beneficiary information as it passes through. And the beneficiary FI, the one at the end, they have a huge job. If the transfer is 3,500 or more, they have to verify the beneficiary's identity if they haven't already. They're the final checkpoint.
There's really interesting little detail in there about smaller transfers, isn't there?
There is. For transfers under 3,500, the data still has to be there, but the sending bank doesn't have to verify its accuracy.
Unless they're suspicious.
Right, it's a balance. They want the data included always, but they're reserving the costly full verification for the higher risk amounts.
That same scrutiny also extends to things like trusts, right? Legal arrangements that are often used to hide ownership.
Absolutely.
Right.
The obligations on trustees are, well, they're absolute. They have to get, keep, and update what the law calls sufficient, accurate, and up-to-date beneficial owner information.
And there's a strict timeline for that.
A very strict timeline. If there's any change to who the beneficial owner is, the trustee has just 15 working days to update that record.
15 days, that's not a lot of time.
It's designed to defeat any delay tactics. And they have to keep all that ownership data for at least 5 years after the arrangement ends, just to ensure there's a solid audit trail.
And if an institution fails to comply or something suspicious is spotted, the enforcement mechanisms are fast.
They're immediate and powerful. The head of the unit can order a suspicious operation to be suspended for up to 10 working days, or they can freeze the funds for 30 days, and they can do it without any prior notice.
So they can lock down the assets before anyone has a chance to move them.
Instantly.
Yeah.
And if there's sufficient evidence of a crime, then the public prosecution gets involved, and their powers are extremely wide-ranging.
What can they do?
They can order searches, travel bans, account monitoring, even interception of communications. They can access computer systems, correspondence, everything. And we can't forget Article 4, which makes the companies themselves criminally liable. The corporate shield offers no protection.
Okay, so that really wraps up the financial integrity side. It's all about who is moving the money and how. But now let's shift gears completely. Let's look at the integrity of the source of the money in the commercial gaming world.
It's a massive conceptual shift. We're moving from, law and finance to technical standards and computer science.
So we're talking about the General Commercial Gaming Regulatory Authority, the GCGRA.
That's right. And the foundation of their technical standards, these GLI protocols, is all about eliminating subjective criteria. The goal is to make sure the gaming experience is fundamentally honest, secure, and auditable for everyone involved.
If the goal is absolute integrity, you have to start with the machine itself. It has to be tamper-proof. What makes a physical gaming device a miniature fortress under these rules?
Well, under GLI 11, the machine has to have what's called a logic area.
A logic area.
Yeah, it's a physically separate locked area that houses the game's brain. The CPU, the program storage, the encryption components, anything that influences the game's outcome. By isolating it, you make it much harder to manipulate.
And the data has to be protected against failure, not just tampering.
Correct. Critical non-volatile memory, or NV memory, must retain all critical data credit meters event logs for a minimum of 5 years.
And the robustness standard is incredible.
It's amazing. That memory has to maintain data accuracy for 30 days if the power is completely cut. And the machine has to be self-aware. If any critical door is opened, the logic area, the drop box, it has to trigger an alarm, disable credit, and throw an error message until a technician clears it.
It's designed with the assumption that someone will try to cheat it, but fairness really comes down to the software, right? The random number generators.
The RNGs, exactly. They have to ensure outcomes are truly random, not influenced by anything else. And the rules get into the psychology of it too. For instance, a game can't display a near miss to make you think you were close. if the RNG actually selected clear loss.
That's fascinating. It's regulating psychological manipulation, not just the math.
The display has to honestly reflect the RNG's result. And what about games that involve skill?
Good question. What happens when human input changes the odds?
If skill, dexterity, logic, whatever impacts the return percentage, that has to be prominently disclosed to the player. And there's a floor. For skill games, the minimum theoretical return that can be disclosed is 75%. It's all about transparency.
And even in the gaming world, the cashless systems have to follow strict security rules, just like a bank.
They do. All those systems have to prevent unauthorized transactions. They need strict access controls, EM pins, passwords, role-based access. And every single action has to be recorded in non-alterable audit logs.
So there's always a permanent traceable record.
Always. Who did what and when.
Okay, let's move to our final section, which deals directly with the player. Responsible gaming and the really tight controls on advertising.
The regulations really put the responsibility on the operators to protect players. They have to provide easy ways for people to self-exclude or set their own limits on deposits and wagers.
And if someone is on that exclusion list,
They must be shielded. They cannot be targeted with any advertising or promotional marketing, period. The operator also has to make player protection information really readable.
what kind of information?
Things like warnings about the risks of excessive gaming, a clear statement that no underage people are allowed, and a list of all the self-protection tools the player can use.
When it comes to advertising itself, the GCGRA standards are surgical, especially around promotions.
They are. Any promotional marketing has to clearly and visibly provide all the relevant terms and conditions right there with the ad. All the big restrictions, like wagering requirements, have to be listed first, not buried in the fine print.
And they have to give an example.
Yes, an illustrative example so the consumer really understands what they're signing up for.
And then we get to one of the most surprising constraints in the whole source material, the rules around culture and language.
These are unambiguous. Operators must not use the Arabic language in any form of advertising until they are explicitly told otherwise by the GCGRA. And on top of that, they must refrain from using any visual or audible representation, direct or indirect, of Emirati or Islamic culture.
That is an incredibly specific and culturally sensitive rule. It seems designed to draw a very clear line in the sand between this commercial activity and national culture.
It creates a very well-defined, highly controlled zone of operation. And finally, the rules make operators responsible for their entire promotional supply chain.
Meaning if they hire an outside ad agency.
The operator is still on the hook. They have to ensure that third party follows all the GCGRA standards.
So the regulatory net is cast incredibly wide.
Incredibly. And they also have to make sure those third parties aren't advertising for any online gaming sites that aren't licensed with GCGRA. They have to police their whole ecosystem.
So to sum this up, we've detailed a regulatory world that demands intense scrutiny of who is transacting, with triggers down to AED 3500, and at the same time, the absolute technical certainty of the gaming system itself, down to 5-year memory retention and verifiable RNGs.
The sheer volume of this detail, from that 15-day window for updating owner data to the ban on near-miss displays and the language restrictions, it all shows that regulatory integrity isn't just a concept. It's built on thousands of specific, verifiable requirements that are mostly invisible to the user.
So what does this all mean?
It means the strict oversight ensures that while the games themselves rely on pure chance, the business and its safeguards are left entirely to verifiable science and law. Which leaves us with a final thought for you to consider. How does this absolute level of regulatory transparency and technical verification change the public perception of an industry that is fundamentally built on calculated risk?
That's something to consider as you process this deep dive. We'll catch you next time.